McDonald's. The name instantly makes you think of burgers, fries, and those golden arches glowing across every city in the world. Think you know McDonald's? A golden arch, a Big Mac, and fries, right? Burgers are just the tip of the iceberg. Could it be that McDonald's isn't just a fast food chain, but one of the most strategic real estate empires in the world? How did a humble burger joint become a global financial powerhouse? And what secrets lie behind its choice of locations, its property ownership, and its franchise model? Today we're going to uncover the story behind the Golden Arches. And it's more than just fast food. In this video, we'll take you behind the scenes of McDonald's. We'll explore its rise from a single drive-in in San Bernardino, California, to a brand that dominates the globe, not just with hamburgers, but with an extraordinary real estate strategy. We break down the origins and growth of McDonald's as a fast food chain, the secret behind its locations and why real estate is key to its profits, how it compares to other chains that focus solely on food rather than property, real-life stories of successful franchise owners and the financial impact of McDonald's strategy. By the end, you'll see McDonald's in a completely new light, less as a restaurant and more as a masterclass in business and property management. If you've ever wondered what makes this brand truly unstoppable, you're in the right place. The genesis, from hamburgers to real estate vision. To understand McDonald's real estate empire, we need to go back to 1954. Ray Kroc was a 52-year-old milkshake machine salesman when he visited a small hamburger restaurant in San Bernardino, California, run by brothers Richard and Maurice McDonald. What he saw changed everything, not just for him, but for the entire landscape of American business. The McDonald brothers had created something revolutionary: the speedy service system, an assembly line approach to food preparation that could serve a hamburger, fries, and a shake in under a minute. Kroc saw the potential immediately. But unlike the brothers, who were content with their single successful location, Kroc envisioned something much larger. In 1955, Kroc opened his first franchised McDonald's in Des Plaines, Illinois. But here's where the story takes its first crucial turn. The early franchise model was failing. Kroc was franchising the McDonald's system, taking a small percentage of sales, just 1.9%. After expenses, he was barely breaking even. By 1960, McDonald's had 228 restaurants, but Kroc personally was drowning in debt. This is the pivotal moment. A lesser entrepreneur might have given up, declared bankruptcy, or sold the concept. But Ray Kroc was about to meet a man who would transform his struggling franchise into an empire: Harry Sonneborn. Sonneborn was a former vice president at Tasty Freeze, who joined McDonald's as its financial guru. And he had a radical insight: forget the burger business. The real opportunity was in real estate. Sonneborn looked at the franchise model and saw its fundamental flaw. McDonald's was helping franchisees succeed, but capturing almost none of that success for itself. The company needed a new model, one where McDonald's success was structurally guaranteed, regardless of how well individual restaurants performed. The solution was brilliant in its simplicity. McDonald's would become a real estate company that happened to serve hamburgers. The Franchise Realty Corporation, the hidden engine. In 1956, Sonneborn established the Franchise Realty Corporation, a separate entity that would revolutionize McDonald's business model. Here's how the new system worked, and why it was absolute genius. First, McDonald's would identify a prime location for a restaurant. The company would either purchase the land outright or negotiate a long-term lease with the property owner. This step alone was crucial. McDonald's was selecting locations with the same rigor that professional real estate developers used. They analyzed traffic patterns, demographic data, visibility, accessibility, and growth potential. Second, McDonald's would build the restaurant on that property, or lease it to the franchisee with specific requirements. The franchisee would pay McDonald's rent, typically around 8.5 to 15% of monthly sales, in addition to the standard franchise fees. This wasn't just rent on a building. This was rent on land that McDonald's carefully selected, owned, or controlled. Third, and this is the key, the rent was based on a percentage of sales or a fixed minimum, whichever was higher. This structure meant McDonald's made money whether the franchisee succeeded wildly or just survived. The beauty of this model was multifaceted. McDonald's now had 3 income streams instead of 1: franchise fees, rent payments, and a percentage of sales. But more importantly, the company was building equity. Every property purchased, every lease signed with favorable terms, was an asset on McDonald's balance sheet. These assets appreciated over time, completely independent of burger sales. Let's put this in perspective. Imagine you're a franchisee who wants to open a McDonald's. You're not just buying into a brand, you're entering into a relationship where McDonald's controls the most critical asset location. You pay an initial franchise fee of around $45,000. Then you need $500,000 to $2.3 million in startup costs. But here's the catch. You also pay rent to McDonald's corporate, whether you own the building or not, because McDonald's owns or controls the land. This creates a powerful dynamic. The franchisee is motivated to succeed because their income depends on sales. But McDonald's wins either way. If the restaurant thrives, rental income rises. If it struggles, McDonald's still collects the minimum rent. And if a franchisee fails entirely, McDonald's still owns valuable real estate that can be leased to a new operator or used for other purposes. By 1960, this real estate strategy had stabilized McDonald's finances. By 1965, the company went public, and the real estate portfolio was a major selling point to investors. McDonald's wasn't just growing restaurants. It was accumulating land in high-traffic, high-value locations across America. The strategic advantage. The location. McDonald's approach to real estate wasn't just about ownership. It was about strategic selection. The company developed a sophisticated site selection process that would become legendary in the franchise world. McDonald's real estate team looks for specific criteria: high traffic volume, visibility from major roads, accessibility, proximity to schools and family-oriented businesses, and demographic profiles indicating disposable income. They analyze zoning laws, future development plans, and even traffic light patterns. This is real estate development at the highest level. Consider this example. In the 1960s and 70s, McDonald's began targeting suburban locations just as American families were moving out of cities. They positioned restaurants near highway exits, shopping centers, and new residential developments. They weren't following trends. They were predicting them. When a McDonald's appeared in a developing area, it was often a signal that the location was poised for growth. This strategy created a self-reinforcing cycle. McDonald's presence often increased the value of surrounding properties. The Golden Arches became a landmark, a traffic generator, and an indicator of a good neighborhood. Property values around McDonald's locations often appreciated faster than comparable areas without such commercial anchors. There's a famous story about McDonald's real estate acumen in Manhattan. In the 1970s, McDonald's secured a lease on a property near Times Square, locking in favorable long-term terms before the area's dramatic revitalization. That location is now on some of the most expensive real estate in the world. And McDonald's lease terms negotiated decades ago are extraordinarily favorable. The restaurant pays a fraction of what current market rates would demand. This pattern repeated across the country, and eventually around the world. McDonald's wasn't just opening restaurants. It was quietly assembling a real estate portfolio that would be worth tens of billions of dollars. Compare this to competitors like Burger King or Wendy's, which traditionally relied more heavily on franchisees to secure their own locations. These companies certainly benefited from successful restaurants, but they didn't build the same real estate equity that McDonald's did. When the market shifted or individual locations struggled, McDonald's had the land. Their competitors often had less resilient business models. The numbers. Quantifying the real estate empire. Let's talk numbers, because the scale of McDonald's real estate holdings is staggering. As of recent estimates, McDonald's owns approximately 70% of the land and buildings at its restaurant locations worldwide. That represents roughly 28,000 properties. The remaining 30% consists of locations where McDonald's has long-term leases, often with favorable terms negotiated years ago. The real estate portfolio is valued conservatively at over $40 billion. Some analysts suggest the true value could be considerably higher, especially when considering prime locations in major cities and the appreciation of land values over decades. Here's what's remarkable. McDonald's annual revenue is approximately $23 billion, but nearly $9 billion of that comes from franchised restaurants, and a significant portion of franchised revenue is rental income. In some years, rental income accounts for more than a third of McDonald's total revenue. This isn't a side business. It's a core pillar of the company's financial structure. Consider the return on investment. A McDonald's restaurant on land purchased in 1960 for, say, $50,000 might now sit on property worth $5 million or more in urban areas. The company has collected decades of rental income from that location, while the underlying asset appreciated. This is the definition of generational wealth building. The real estate strategy also provides financial stability. During economic downturns, when restaurant sales might decline, McDonald's still has valuable assets. During the 2008 financial crisis, while many restaurant chains struggled or collapsed, McDonald's remained stable. The real estate portfolio provided a cushion that franchise fees alone never could. McDonald's has also used its real estate strategically for corporate purposes. The company periodically sells properties to raise capital, then leases them back under favorable terms. This sale-leaseback strategy has generated billions in cash while maintaining operational control of the locations. It's financial engineering at its finest, using real estate as both an asset and a financial tool. There's another often overlooked benefit: leverage in negotiations. Because McDonald's owns the land, franchisees have limited negotiating power. If a franchisee wants to leave the system, they can't just take the restaurant elsewhere. It's on McDonald's property. This creates extraordinary franchise retention and gives McDonald's tremendous control over its brand standards and operational consistency. Lessons from the Golden Arches: strategic insights. What can entrepreneurs and business strategists learn from McDonald's real estate empire? There are several profound lessons embedded in this model. Lesson 1. Control the critical asset. Ray Kroc and Harry Sonneborn understood that in the restaurant business, location is everything. By controlling the land, McDonald's controlled the most critical variable in franchise success. This principle applies broadly. Identify the irreplaceable asset in your business model and own it. In technology, this might be intellectual property. In manufacturing, it might be supply chain infrastructure. In services, it might be customer relationships. Whatever drives enduring value in your industry, structure your business to own or control that asset. Lesson 2. Build equity, not just cash flow. McDonald's could have continued with the original franchise model, taking a percentage of sales and earning steady cash flow. But cash flow alone doesn't build generational wealth. Equity does. By shifting to real estate ownership, McDonald's built assets that appreciated independently of operational success. For entrepreneurs, this means thinking beyond monthly revenue. What are you building that will be worth more in 10, 20, or 50 years? How can your business model accumulate value over time, not just generate income? Lesson 3. Create aligned incentives. The McDonald's real estate model aligns incentives brilliantly. Franchisees are motivated to maximize sales because their income depends on it. But McDonald's succeeds regardless because rent is based on either sales percentage or a minimum floor. This removes the company's dependence on any single franchisee's performance. In business partnerships, employment structures, or investment deals, aligned incentives create resilience. Design agreements where all parties benefit from success, but no single party's failure destroys the whole. Lesson 4. Think systematically about scale. McDonald's didn't stumble into real estate ownership. It was a deliberate strategic pivot designed to enable massive scaling. The franchise model alone couldn't support rapid expansion. The real estate model could. It provided the capital, the control, and the financial stability to grow from hundreds to thousands to tens of thousands of locations. When scaling a business, identify the bottleneck, the constraint that limits growth. Then redesign your model to eliminate that constraint. For McDonald's, the bottleneck was capital and franchisee reliability. Real estate ownership solved both. Lesson 5. Value is in the land, not the building. This is perhaps the most fundamental insight. Buildings depreciate. Equipment breaks down. Trends change. But land, especially well-located land, appreciates. McDonald's understood that the physical restaurant was a depreciating asset, but the land beneath it was an appreciating one. For investors and entrepreneurs, this reinforces the timeless principle: invest in assets that gain value over time. Whether it's real estate, intellectual property, brand equity, or human capital, focus on what appreciates, not what depreciates. The modern McDonald's. Adapting the model. McDonald's real estate strategy hasn't remained static. The company has continued to evolve its approach to match changing market conditions and opportunities. In recent years, McDonald's has implemented more sale-leaseback transactions. The company sells properties to real estate investment trusts or other institutional investors, then leases them back on long-term agreements. This generates immediate capital that can be used for technology investments, menu innovation, or returns to shareholders, while maintaining operational control of the locations. McDonald's has also become more strategic about international real estate. In emerging markets, the company often partners with local real estate developers who understand regional nuances. In mature markets like the United States, McDonald's is increasingly focused on optimizing its existing portfolio, relocating underperforming restaurants to better sites, renovating dated properties, and occasionally closing locations where the real estate is more valuable for other uses. The company has also embraced new formats that reflect changing real estate dynamics. Smaller urban formats, drive-through-only locations, and partnerships with retailers and transportation hubs demonstrate that McDonald's continues to innovate how it thinks about space and location. Technology is also reshaping the real estate calculation. With the rise of delivery apps and mobile ordering, foot traffic patterns are changing. McDonald's is analyzing how digital ordering affects location strategy. Do you still need the same visibility from the highway if customers are ordering from home? How does delivery impact the value of dining room space versus kitchen efficiency? These are the questions that McDonald's real estate team grapples with today. But the fundamental insight remains: control the land and you control your destiny. Comparison to competitors: why others couldn't replicate it. It's worth asking, if this strategy is so brilliant, why haven't all fast food chains done the same? The answer is timing, capital, and vision. McDonald's implemented this strategy early, when real estate was relatively affordable and the company was still small enough to pivot decisively. By the time competitors recognized the power of the model, McDonald's had already secured thousands of prime locations. Burger King, Wendy's, and other chains have certainly recognized the value of real estate, but they approached it differently. Many relied more heavily on franchisees to secure their own properties, or used traditional lease models without the same level of corporate land ownership. This meant less capital required up front, but also less long-term equity accumulation. Some chains have tried to implement similar strategies in recent decades, but the best locations were often already taken, frequently by McDonald's. There's also the chicken and egg problem. You need capital to buy real estate, but you need real estate equity to raise capital. McDonald's solved this early and created a flywheel that competitors found difficult to match. Chick-fil-A has taken an interesting alternative approach, maintaining tight corporate control but typically leasing rather than owning properties. Starbucks has invested heavily in prime retail real estate, though more focused on short and medium-term leases rather than outright ownership. These strategies have their merits, but they don't create the same generational asset base that McDonald's has built. The McDonald's model also required unusual foresight and a willingness to sacrifice short-term profits for long-term asset building. Many competitors, under pressure from investors for quarterly results, couldn't justify tying up capital in real estate that wouldn't show immediate returns. McDonald's leadership, particularly Kroc and Sonneborn, had the vision and discipline to play the long game. So let's return to our original question: is McDonald's a fast food chain or a real estate empire? The answer, as you now understand, is that it's both, and that's precisely what makes it extraordinary. The hamburgers bring in customers and generate sales. The real estate owns the land, builds equity, and creates enduring wealth. These two elements work in perfect synergy, creating a business model that has proven remarkably resilient across decades, economic cycles, and changing consumer preferences. McDonald's serves billions of customers every year, but its genius isn't just in the speedy service system or the consistency of its fries. The genius is in understanding that location is permanent value, that land appreciates when trends fade, and that controlling the ground beneath your business gives you leverage that competitors can't easily replicate. Ray Kroc's statement, "We're not in the hamburger business, we're in the real estate business," wasn't hyperbole. It was the fundamental insight that transformed a struggling franchise into one of the most valuable companies in the world. The burgers paid the bills, but the real estate built the empire. For those of us studying business strategy, McDonald's offers profound lessons. Think beyond your core product. Identify the asset that truly drives value in your industry, and find a way to own or control it. Build equity, not just revenue. Create business models where your success doesn't depend on any single transaction or relationship. And most importantly, play the long game. Real wealth compounds over decades, not quarters. Whether you're an entrepreneur, an investor, or simply someone fascinated by how great companies are built, McDonald's real estate strategy is a masterclass worth studying. It reminds us that the most powerful business models often operate on multiple levels. What you see on the surface is just the beginning. The next time you drive past those golden arches, remember you're not just looking at a restaurant. You're looking at one of the most sophisticated real estate portfolios ever assembled, hiding in plain sight under the guise of selling hamburgers. That's the McDonald's empire. Brilliant, strategic, and utterly unique. If you found this deep dive valuable, make sure to like this video and subscribe to the channel. We're building a community of people who want to understand business at a deeper level, beyond the surface narratives. Drop a comment below what other companies have hidden business models that are more complex than they appear. I read every comment, and your suggestions shape future content. And here's your challenge. Look at your own business, your investments, or your career with fresh eyes. What's the real estate, the appreciating asset in your world? What could you control or own that would give you leverage and build value over time? The principles that built McDonald's empire can be applied anywhere. The question is, will you have the vision to see the opportunity and the discipline to execute? Thanks for watching, and I'll see you in the next video.